All right guys, what we're going to cover now is volume and delta. Now, for those of you not heard of delta, don't worry, we're going to get onto that in a little bit and cover off that. But ultimately, delta is a different variation or a different way of showing or illustrating volume in perhaps a slightly more detailed way. So we'll come to that in due course. We're going to start off with volume. And the reason for covering volume and delta as opposed to many other indicators is that these deal with what's actually traded. Almost every other indicator deals with price. Now, we can see price from a candlestick chart. You can see price as you watch a ladder, you see price change. So any other indicator that deals with price ultimately takes that price, repackages it in a different way, and shows it back to you. Think of a moving average. It takes a number of prices, averages them out over time, and displays it. Now, you know every one of those prices that's traded. Yes, you may not know the average price, but you saw each of those trade, and the information that you got from the volume that traded as they did, from what exactly happened as they traded, is arguably much more important than having an average of the last 20, 50, 100 prices, however many you want to use. There are uses for moving averages, and we'll perhaps cover that a little bit when we look at entry and exit strategies and methods to trail stops, methods to stay in trades, but we'll come back to that in due course. So we're going to start off with volume. We're going to then move on to delta in part 2. All right then, volume and delta. What we're going to start off with then, volume. Now, the reason for doing this is it's a way of distinguishing. Now, an indicator on its own is never going to give you a trade. And that's something that I want you to maintain in your mind when we're going through volume and delta. That it's about saying you've got enough information now that makes something you're already looking for a much more palatable idea, a much better choice now than it perhaps was just previously. And the whole idea behind that is that two moves can be seen exactly the same when you look at it on a candle. But one that has volume has so much more strength. And the reason for that, quite simply, is if volume has happened, people have been pushed into positions. Long, short, whichever way they've gone, people are now involved in this. So action has taken place to move. Whereas if no volume happens, a market could drift. Now, if it drifts, there's no clarification that people really want to trade at those prices. It may well be the fact that there is very few other people there willing to trade, in which case, let's say someone's buying and there are very few sellers, price can move a fair distance, but it's more because the fact that the person wanting to buy is forced to pay higher prices because there literally aren't enough sellers there. And this is why volume is so important. If a market moves the same distance but trades significant volume, what this is now showing you is that effort has been made. Sellers are there and they have been taken on and defeated for the price to continue to move higher, if you want to view it as a kind of battle scenario. So ultimately, volume gives meaning to a move. And we probably all know this type of thing. Certainly anyone who's got a bit of experience knows that. So what we're going to have a look at then is general uses of volume. Now, we all know the main one that most people look for. It indicates movement, it indicates an end of move or confirms a move. We're also going to cover a bit on prevention of overtrading, understanding where volume is likely to happen. I don't think people often spend enough time considering when they expect volume to happen. Is volume actually adding up with what it should be at this time of day, this period? That's what really matters as well. And one of the most crucial things with volume is relative volume. Now, I don't mean this in terms of an R-vol indicator, but this is something that as you're seeing a day progress, you're looking at how volume shifts relative to how it has been. That's the bit that gives you a bit of information. And it's not about being able to say, right, this is defining what is more than another. Think of looking at two cars moving. You can see which one is moving faster. You don't know precisely how fast it is going, but relatively, you can see that one is moving faster than another. That's the important thing when I'm talking about relative volume. So we're going to have a look at confirming moves, illustrating there might be a second move, and this is all about sustaining volume. We're also going to look at volume peaks and the ends of moves, how exactly moves come to an end, because moves don't all come to the end in the same way. Ultimately, they do, in the sense that volume falls. But how that happens varies. So we're going to go and cover that and look at the different ways that volume falls, whether it's instantaneous and what timeframes mean in terms of volume shift. And then first up, what we're going to touch on is using volume in a way that I think people don't often view it, to illustrate when you want to trade. When's an ideal time for you to be trading? To stop you over trading. To indicate qualities of movement. This is what's really important. This is the kind of thing that people miss out. So we're going to start off here. And there's no right or wrong in this sense. And it's about understanding what works for you. When do you feel that you have the greatest degree of edge? What conditions suit you? And trying to define those. Volume gives you a great way of doing it. Looking at chart movement, it's very hard to define that these conditions are the same as those conditions. Whereas you add volume in and all of a sudden you can see that this is a similar type period of movement. So we'll cover volume and volatility. Right then, time to be involved. What we're trying to do here is filter. You're trying to filter out when you need to be active and not. Now, personally, I find that higher volume periods are much easier to trade than lower volume periods. And that's not the same for everybody. And within that, there are then parameters as to how high volume needs to be or how high volume can move before it becomes almost overly tough to trade. There's a kind of sweet spot, and that's the bit that you're looking for yourself. So one way that I would suggest doing this is to actually spend time tracking where you performed well, what conditions you feel most comfortable in. And to start with, this could literally be a case of noting down time. You know, note down the periods where you felt that the market was most conducive to your style, where things made the most sense, where things moved in a way that you felt you understood. Note those down. Start to look at the volume during those periods. That's how I came up with something I'm going to show you coming up in a moment. So that I can then say, right, I don't need to be involved here. It's a great way of just filtering out trades that otherwise are tempting. I personally find that lower volume periods become very tempting to trade. The reason being, markets will still move. Not much is going on, but they still move, which presents ideas, presents trades. And that tempts you into something. That makes you think, yes, there might be something on here. But the lack of volume is always going to limit the ability of that move to happen. And so you can get sucked into traps in lower volume periods. So you're trying to create parameters for yourself to work in, and also do this on a short time frame. If you take this onto a longer time frame, as I'll show you when we look at volatility and volume, what you end up with is a situation where you kind of do nothing for perhaps a month or so, waiting for volume to increase to a level that you want on a daily or an hourly basis. And in that scenario, you're limiting your options. So really what you're trying to do is define within the day where those greatest opportunities are, where you want to be trading. Take for example here, much higher volume period, lots more goes on here. You take the lower volume periods, much less. What we're going to have a look at is trying to look at volume in terms of giving yourself absolute numbers. Now, with the absolute numbers, this is something you're going to have to self-define. This is something I look at in oil. This is on a 5-minute chart, and I have a parameter of 7 to 3,000. Volume in that range, good to trade. That's the kind of zone that you'd be happy to trade within. Anything that falls out of that, you don't really want to get sucked into it, because you can fall into periods like this, a lack of activity, not much going on. Anything above 7,000 could then be suggestive that actually either markets are getting almost too fast, or that these are, if you will, ideal conditions. This is tradable, if you view it like that, the 3 to 7,000 zone, and you're happy to trade in those environments. That gives you opportunity. But once you get over 7,000, this may well be a point where you've got much more opportunity, and this is the time where you can become more active and start pushing trades that little bit more. That's one way that I try and look at these types of things. And you can do this for every market. There's no point in me going through every single market, but you can do this yourself for every market and work out for yourself what conditions you like to trade. For some people, they may be very comfortable in these sideways or choppy up and down ranges that generally have low volume. And if that's a period that suits you, trade it and focus yourself towards that. And then once you go over a certain limit, that may be a good indication to just step back, step away. Now, this is something that I developed a little while ago in the DAX. Again, a similar kind of parameter to trade within. DAX for me, looking at 200 to 400 contracts per minute, and using that as a kind of bar that anything that falls under that, I don't want to be involved in. These are generally periods that I know that I can run into traps, get caught out in these sort of slow, limited action zones up here. That's what I don't want to be involved in. What I want to be involved in is the much more directional movement. Directional movements inherently have more volume because more is going on, you're covering more prices, and so therefore you need more trade to drive through those prices. And so after a period of sort of experimenting with this, looking at when I feel that I perform best, when I feel that I'm most comfortable, where I feel I have the greatest understanding, came to a conclusion that somewhere between 200 and 400 presents enough opportunity to trade, enough opportunity where there is money to be made, where trades can be taken on, without limiting myself to, let's say, if you say 800, you're stuck with only a few minutes in a day where you're actually going to be able to trade. And some days you won't even get that, as I'll show you in a moment. So what I'm trying to do is get myself towards these periods where consistently we're seeing around 200 to 400 contracts, and this gives you a pretty significant move. 170 ticks in the DAX is a reasonable size move. Once that's happened, volume does stay up, and you get long periods of consistent movement into this 2 to 400 contract range. Again, decent periods to trade. You're getting these periods 100 tick wide range here, whereas to start with, beginning of the day, very, very narrow range. You're kind of moving in about 20, 25 tick range. And this runs for the early part of the European day. And just bringing it back here, 400, 200, these two blue lines down here. This is a day, compared to that previous, where very, very little happens. We struggle on this day to find many days, many minutes that actually tip over 400. You've got the open, you've got a bit of US data, and you've got the close. And apart from that, nothing else gets above 400. And in fact, there's very little that actually gets much above 200. The period where US data comes out gives you a little spike above 200, but for data, that's very low. And again, this is something to consider. Looking at different periods, when data comes out, for example, what do you expect volumes to be? Sitting within a normal type range on the back of data is still very, very limited. And so it would actually suggest that even though this is high, certainly compared to the rest of the day, it is nowhere near what you'd be looking for on data. You see here, only 1 minute of the day top 600. That previous image, we have multiple periods that top 600 and fair few that top 800. So that's then giving you that illustration of when you want to be involved. It is a personal thing, and it is something that you're going to have to put that study into working out what works for you. So get onto that, start thinking about these periods, start noting down times when trade suits you, when you feel most understanding, most comfortable trading. They're the periods that you want to focus on, rather than just simply saying, right, I'm going to trade all day, I'm going to trade any setup that comes along. Because without volume, certain trades are less likely to work. Having an idea of your distribution of volume throughout the day as well is another great way of being able to sort of navigate your day. A day is not a linear thing that happens in a uniform way, and that you see the same thing throughout the day. There are going to be periods of more activity. Quite simply, people need a break. People go for lunch. You can see it here. Dips in volume, dips in volume. I'm using it as an example here, and I'll show you some of the other kind of volume profiles on a day, if you will, in a moment. This is European bonds, European stocks, so DAX and Bund to give the illustration. And you see this very distinct pickup in volume. This comes on the cash open. That's where you'd expect the highest, or one of the highest periods of volume. There's a very clear distribution in almost every market that there's this kind of U-shape between volume peaking at the open and volume peaking at the close of the cash session. Outside of that, volume then dips off. So you actually kind of end up with this sweeping M shape, if you will, in terms of volume pickup into cash open, fall, back up, and down once more. So you need to then understand where the volume comes in, where the influence is on volume as well, because there's correlated markets out there, particularly if you're looking at European and US markets. If you're looking at the S&P, for example, you will still see a pickup in volume, even though you're not in the main session in the S&P as the European equities open. So you need this understanding. This period here, this is 8 a.m. UK time, and then we fall off into lunchtime. The lunchtime period is generally the period where you're going to get less and less happening. Bonds are a little bit more consistent. Equities have a much more sort of pronounced shift in volume throughout the day. Bonds, they're a little bit more consistent throughout the day. With European equities and bonds as well, you end up with this spike of volume on the Eurex open. So this is when the greater degree of Eurex trade comes in. You have an overnight session on Eurex, and then you have this open period, the hour before the cash session open, and that's where a lot of trades typically get put through. So you get this kind of pre-open volume spike, and then the proper volume spike on that cash open. The equities, much more notable spike in European equities on the US open and then on the close, and then still a little drag up into the US close as well. So it's about, again, scheduling your day out. Knowing that if you don't like quiet periods, go to lunch. It could actually be advantageous to go to lunch when you know that volume falls, and you know the kind of profile of volume throughout the day. This also gives you a way of mapping out what you expect. If you see a really low volume open, it's giving you a little bit of clue early on. You can start thinking, this is perhaps not going to be the day that you're looking for. This is perhaps going to be a quiet day. If you can't even get volume and participation early on, it's probably an indication that as more and more people go to lunch, it's going to get even quieter. So that gives you the map of European equities, so DAX, Euro stocks, very, very similar type structure. European bonds. You actually see more volume comes into European bonds as you get into the US session than you do even at the open and the close of European bonds. It's the influence of US data and the the US bonds opening that gives that kick up in volume. If we go and look now, what I've got over here then is in the top left, I have oil, euro dollar, FX, T-note, gold, and S&P. S&P, NASDAQ, Dow are all, Russell even, are all going to have very, very similar volume type profiles throughout the day. You see a very similar type structure in the US equities. You get the little spike up on the European cash open. You get the very significant bump up going into the US open, and then again that sort of U-shaped profile going into the US close. Typically you're going to get more volume going into the close, but I'll talk about this a little bit more when we look at volatility, because volatility influences where the volume shifts throughout the day. Currencies. Now, currencies are a slightly different animal because of the fact that they don't have a strict cash session. And dependent upon where you are going to have to consider the volume distribution in currencies. Asian currencies, so things like the Aussie, yen, are going to still exhibit perhaps a little bit more volume here in what we would call the overnight session because of where they are, where they're geographically located. But still, the majority of currency trade runs from Europe through the US. So this is particularly the period here where you have both the European and the US markets open at the same time. This is where you get the greatest degree of crossover. The majority of currency trade still does go through London as well, hence why we see a greater degree of volume. And you'll see this in all currencies over the middle of the day. Again, picking up as you run into the US session, and then you have the London fixing. When we get on to order flow events, we'll talk a little bit more about the London fixing, but this is the period of time, or the period in time, where any derivative contract pricing is done and they're fixed to the price that is quoted at 4 p.m. in London. So that is a sort of quoted price which is used from a kind of margin call perspective on any kind of derivative products, cash products, any of those types of things. The marking to market of assets is done based on that London fix. This is why you see so much volume going through here. That's effectively like a close. And you then see volume drift off throughout the rest of the day. WTI oil. So we're going to look at WTI. This is US oil here. WTI oil moves through different periods. You have a period where you have the Oman contract, which trades on the Dubai Mercantile Exchange. So this runs then through the night. You have Brent coming in early on in the day, and then volume really picks up going into the WTI open. So the WTI cash session, as you know, runs from 2 until 7:30 UK time. That's where the volume really picks up. And then again, you can see this pick up, drops back down, then you get the surge of volume into the close before the drift off once again. We'll cover next gold, which is the one down in the bottom left-hand corner. Gold, again, very, very similar in terms of movement to bonds, and slightly less so currencies. Gold really does put its main trade in during the US session. Much shorter session in general for gold, and a much less limited, or sorry, a much more limited close. You don't see a huge amount of action on that gold close compared to many others, which see often the highest volume of the day going into the close. Incidentally, the blue line that I have that follows the volume histograms gives you an indication of the average volume at that period of time. So that's what the blue line starts to show you. So there are periods, take here for example in gold, where we're seeing much higher than average volume in that period of time. Again, another good way of indicating action, indicating whether you should or shouldn't be involved. And then finally, you've got T-note. Last chart on its own on the right. Again, similar kind of structure. You have the quieter overnight session. You get the European bonds opening, and that gives a little bit of volume, which quiets off into the European session, and then much more significant pickup in volume as you go into the main bond session. And again, spike going into the close. Typically in the US as well, and another time to watch out for, high average volume comes at around 6 p.m. UK time. This is when the US auctions its bonds. So any bond auctions, which again we'll come on to when we look at specific events, will be done at around about 6 o'clock. And that's where you're going to get these very significant jumps in volume in bond markets. So understand your profiles of the day. Understand where the volume is, where you can expect that volume to happen. What we now want to have a little look at is volatility. And often there's a kind of misconception between volatility, liquidity, and volume. Now, typically, higher volatility creates more volume. Now, Often it's perceived slightly differently because volatility reduces liquidity. Now, this isn't necessarily always the case. What happens is that as volatility increases, market can move through more prices. Volumes go up because to move through more prices, market has to trade more. You have to kind of put in more energy to move more distance, if you will. Liquidity falls in the sense of the number of contracts at each price. And we'll look at this when we go into crisis trading, we'll see what low liquidity markets look like. Liquidity at each price falls. So you may go from seeing a 20 lot at almost every price to seeing a 5 lot at almost every price. But the fact that you trade through so many more prices means that liquidity is still there. It's just more dispersed. And that's the difference. So liquidity is still there. And generally, more volatility brings in more volume because more people trade. Market changes, the way it's trading, where it's trading, shifts consistently throughout the day. And in doing that, this then causes greater degree of volume. Take, for example, here. This is where we got much higher volume, March 2020. The VIX was at 75, so a measure of volatility. And you're seeing consistent volume of around about 450,000 contracts per hour. Going in towards the ends of days, 450,000 contracts per hour. You go over to a period going into the end of November 2021, the VIX is down at 17, still not at its lowest kind of levels that we've seen. And now you're reaching 150,000 contracts per hour. Yes, you're seeing some peaks above, but rarely do we, in fact, you just about touch over 250 contracts over one period. Whereas high volatility, you're doing nearly double that every single day. At least once within the day, you're topping that. And consistently throughout the day, if you draw an approximate line here, there's 250,000 hit almost every hour of the day. So volatility, because of the amount of prices that get moved through, increases the amount of volume traded. What it also does is change when the trade happens. You generally see volume shifting towards the end of the day as opposed to the beginning of the day. You look in the lower volatility periods, see that little volume profile or volume distribution that I've got, reasonably even. The open and the close spike to around about the same type of volume in these lower volatility periods. Higher volatility periods though, much, much different. Opens, closes. You're seeing perhaps double the volume done on a close than you are done on an open. And part of the reason for this is people or perspective changes so much throughout the day. People's views on what's happening shift so quickly throughout the day that the end of the day gives people more clarity than perhaps the beginning of the day. And so you get this slightly limited relative change at the beginning of the day, and then more volume going in at the end once people understand what's going on. Also, during periods of higher volatility, holding times on trades generally reduce as well. As such, people get out of trades as well at the closes, more so than they do in lower volatility periods. Just to give you an indication, this range here, if we go just there, gives you around about a 60 handle range. If we look at the range done just here, 500 handles. Over 4 days, this over 4 days gives you 60. So you're seeing nearly 10 times the movement over that period of time. And you can see now why people aren't so keen to hold on to trades, because things can change very, very quickly. So a little spike like this, that comes in and gives you around about 200 handle movement. So that's also something to consider with volatility, how much volume you can expect to see. And it's not about, and this is why you can't ever look at volume in absolutes in terms of assuming that you have the same volume every day, and those parameters to trade within equally may need to shift up. When volatility increases significantly, take that 200, 400 example I used in the DAX, that could be blown out of the water. We could be over 200, we could be over 400 in almost every single candle. So now you may need to shift those parameters up. So it is an ongoing process of looking at periods when these things suit you. Alternatively, that 200, 400 DAX example that I gave may well indicate that you want to be trading significantly more because opportunities suit you at that period of time. Final thing we're going to look at in terms of looking at volume and the distribution of volume throughout the day is looking at average volume per time period. Now I've used this a fair bit here. And what you're trying to do here is then use it within the day so that you can say within a day, right, one way that I'm going to look at this or have an expectation of movement is that if I start seeing volumes ticking up above the average, so I have an expectation of what I'll see at a certain time of day. You see here that you're starting to peak at around about that 150,000 contracts as we used in that previous example, and you start seeing volume ticking up above it. This all of a sudden says to you, yes, there may well be more opportunity in terms of size of movement. that you can start adjusting your expectations. You can start expecting that now if you take a trade on, that target can be bigger. There is more scope for movement. Just by looking at the volume compared to an average, or looking at the volume compared to, and you can note these things down. On a daily basis, note down what the volume was in the first hour. When you see volume picking up above that, it's quite an easy way to think to yourself, aha, there could be more on today. There's a greater scope for action on the day than there was perhaps on previous. And what this serves to do as well is that greater volume opens the market up, if you will. It moves people around a bit more, and that creates more volume as it brings more trade in. We move into new areas that is going to instigate greater trade, and volume then, after seeing an initial spike up, continues to rise. This is going to drag the average volume up, and then you go through periods where you then start to see the average volume falling back down. After seeing consistent days where volume beats the average almost every candle of the day, all of a sudden we're starting to fall back down. So whilst yes, we're above average, relative to how much above average we've previously been seeing, this is now indicating a bit of a downtick. And the next day comes in, much, much harder to sustain that level of trade that we were previously seeing. Averages get pulled back down, action starts to drop. Market becomes that little bit quieter once more. It's about being able to manage your expectations. Being able to say, yes, today I think there is more scope, or being able to say, today I don't want to get involved. Right then. So we've looked at then giving a method to deciding when you want to be trading. What we're going to be looking at now is specifically how you can use volume. So when it is helpful, how it's going to indicate the end of a move, the beginning of a move. This is what you're looking for. And it's all about context, because where volume happens matters in terms of what you can expect to come out of it. So the first thing is inside a range. If you're inside a range, you start seeing volume increasing within this range. This is a good indication. It's starting to show that something's happening. Something's beginning. And so this is now an indication this range can break. You've got scope for movement. And this can be one of your early clues. Any kind of technical pattern, this doesn't necessarily have to apply to a range. A range is perhaps the easiest thing to think of, because with a range you can imagine that if you're trading up and down in a range and volume then starts to increase here, it doesn't mean that we're necessarily going to break the range to the upside. But what it does mean is you can now be a lot more interested when you get to the high, because if that volume continues to grow, you can expect the break now. So it enables you to time things that much better. That's where volume is useful when you're inside a range. When you're inside any kind of technical patterns, it gives you that chance to go, right, this time it's going to go. And we're going to look at this in more and more detail using delta to break that down a little bit further. What you're expecting generally is that volume's going to fall at the edges of range. You might see volume increase towards the edge, but generally it's going to fall off, and then you'll start to get a situation where the market falls back down. So it's all about that relative shift. Now, with any kind of breakout phase, what you need to see is a change in volume at that point. So whilst it's helpful inside a range or inside a technical pattern, what you need to be aware of then is what the volume was like the last time we traded at the point, let's say, where you want to buy or you want to sell. If you're trying to play a breakout, you need to know what the volume was approximately the last time you got there, and now what the volume's looking like. So if volume started to increase at that point, all of a sudden, this is the indication that says to you now's the time to go for it. It's a great way of timing your trades. But also, what you need to be looking for is you need increasing volume. You need that volume to sustain. Otherwise, it could well be a drive of volume, it gets people involved, and without continuation of movement up and sustained volume, this move could be over very, very quickly. So that's going to be crucial. And this then leads to the difference between a breakout and the end of move. Because ultimately, for an end of move, volume falls. And the reason for this is that as the market moves higher, you run out of sellers, and we'll talk about this more with auction theory when we do profile. Price moves up, you don't run out of sellers, you run out of buyers. What happens as price moves higher? Sellers think, brilliant, this is good, we can sell. You're going to get less and less buyers as price rises. As we all know, the more price goes up, the more you think, I don't really want to buy that anymore. So you run out of buyers. This naturally means that volume falls. It may fall in the instant, so it might, from a volume histogram, look like you've had a huge amount of volume traded here, but the amount of volume traded at the point of the move is generally going to be quite low, because this is the point where you find the last buyer and the market then starts to drop back. Now, this can happen in an instant as an exhaustion type move. So you get this very high volume flash and the market then stops and reverses. And that volume drop happens almost instantly. Or it can happen over a very slow period. And I'll give you an illustration of this in a moment, but it's that relative drop off of volume that allows the market to turn. Because for a market to turn, first up, what you need to see is volume fall, and then volume start to rise in the counter direction. And like I say, this can happen in an instant, matter of seconds. It may take 5, 10, 15 minutes, an hour, 2 hours to happen. But that relative drop in volume is what's key to being able to say this move is finished, and maybe now we can go back up. The other thing that's important is time frame. Because these principles apply differently when you consider different time frames. And generally, ends of moves on larger time frames are going to exhibit a drop of volume from a histogram perspective before the reversal. Whereas from a short time frame, you're generally going to see a much bigger spike of volume, which is that immediate, or the instant where the change comes. That instant where you finally run the move out. It's the exhaustion part of the move. So time frame is crucial, and understanding the difference between what a reversal looks like on, say, an hourly and on a 1 minute or 5 minute chart is crucial to understanding how you apply volume. So let's go start off with looking at that relative change in volume. This is crucial. We'll bring order flow into a move like this as we go into the order flow week. So what we're looking for is quite simply break of lows. You've had numerous tests of these same levels, and as we all know, more tests of a level, greater expectation that it's going to break. So the level comes in around about the 174.20 to 15 area. So this is the zone that we're expected to break, just down here. Now, you get down there, you're looking for the break. The temptation, of course, is to look at this from a technical point of view and say to yourself, yep, we've been here numerous times, this is going to break, I'm going to sell it. But what happens is volume doesn't increase when you get down there. You get a move that dribbles down, not a great deal goes on, market stays very, very stagnant, and we end up with this reversal back. Quite simply, you don't have any change. And if you don't have people driving the move, nobody else joins in, the move doesn't drive any longs out, and so therefore you don't get the break. So you've now learned something here. And quite possibly, if you've been looking at this over each of these other iterations, you will also have learned that there is a distinct lack of volume when you get down there, i.e. there's a lack of willingness to drive it through those prices. So next time, you know what you're looking for. You want to see volume, not flat like this at around about the 5,000 lots per minute, per 5 minutes. You want to see it increasing. All of a sudden we get that. And you get that on the way towards the level as well. So not only do you get the indication that the level is likely to break, you're getting an early indication because the volume starts to increase here, which can potentially give you the opportunity to get in early because you're seeing something different now. And yes, arguably, you're seeing the same as this. And that first move down to the level that we get here. But equally, you can take this on. You could take this on, if you're selling it into the level and it doesn't break and you see volume flattens off, you give the trade up. Here, you sell it into the level, volume doesn't flatten off and volume continues to grow. This is now saying to you, the break is on. Volume rises, we break through the level, and yes, we pull back. Now, this becomes the point where you're going to have to make a decision. Volume on its own here is enough to say to you, yes, this is a good opportunity and you can take this on. Once you get down to the level, this is where things can change and you have to make a judgment now as to whether this can keep going or not. If you're expecting that this breaks and continues straight on, you're in a situation where this move is over when it starts to stagnate. If you're expecting that a break of the level may well trade around the level and go again, then you're okay, you can stay with it. Alternatively, as you see the volume fall off, and then you start to see volume increasing in this move, you can join that and you can play that move down. So it's about understanding what you're looking for, but the volume is enough to say, yes, this time it's worth going for. That's what you're looking for when you get a breakout. And so much of trading, of analysis, is all about knowing what you're looking for. And if you get what you're looking for, then you take the trade on. Rather than waiting for it to tell you to do something, you already know that you want to see a volume increase towards the level. And if you get that, you're going for it. A sustained break then. This is what you want to see for a continuation of movement. Now, what I've got here is a 60-minute chart on the left and a 1 minute chart on the right. What we're after here then is one, to get into a move, but then to have the conviction to stay in the trade, and volume's a good way of keeping you in. As long as you're seeing volume increase, you can be confident of staying in this trade. Now, what we've effectively got is a move lower, a flag for the breakdown. And this breaks through 65.50, which also breaks through the previous couple of days' lows. So you know that this could be a potentially significant movement, despite the fact that prior to it, we've seen a reasonably quiet drift down. So you're looking for significant movement. And what you get here then is you get a little touch up in volume. Volume increases just as the flag starts to break. That's his first little spike of volume just down here. After that though, volume then continues to rise through the next couple of candles. Now it's always easy in hindsight to say, well, that's where you should get out, but you don't know on the next candle whether the volume's going to continue to rise. So realistically, you are going to be staying in as you start to get this candle with a much larger wick coming in. As you then start to see volume falling off, and again, relative matters here. Relatively, we're much higher volume than you were prior to this, than you were in the flag. But relative to the initial drop, volume is now starting to fall. This is your indication that the move may well be coming to an end, at least in the short term, and should be your suggestion that perhaps now it's time to start considering exiting the trade. It doesn't mean just get out the first time volume falls, because volume compared to what we previously were is much higher. But you can now start thinking, do I have a target? Do I have a level? This may well be an indication that the move is going to struggle. And you see, after the first 3 candles that move us from here to here, the next 1, 2, 3, 4, 5, 6 candles don't put in as much movement. They give you another 30 ticks, whereas the first move gives you a full 60 ticks. You get an extra 30 ticks for a much longer period, a much choppier trade. And this is because volume's starting to fall. Reason being, you're struggling to find people willing to sell now after the move has already started on its way. So you get the sustained break, and that increase in volume continuing to build as the move goes, it's a great way of being able to say to yourself, right, I don't need to do anything until I start seeing volume fall, then I can consider my position. Then I can consider whether I still really want to be in this trade. Okay, so I talked about volume and rejecting movement and how that differs between a 60-minute time frame on the left, 1 minute time frame on the right. What we're starting to see here then is that on this breakdown, so this is moving gold. The move down comes through 1798, 1796 is this blue level, that's this level just down here. So we get the breakdown in gold. For a 1 minute perspective, volume is huge. Massive spike in volume, perhaps starting to push towards 10 times the volume that we've been seeing previously. So enormous jump, instantly as well. But when you look at this from the perspective of an hourly candle, volume's actually lower. The blue highlight that you can see there going down onto that smaller red candle, yes, relatively it's slightly higher, but this is reasonably low volume for gold on an hourly basis. So actually what this is indicating to you is that this is a reasonably low volume movement in terms of the period after that candle. So what we're seeing then is one instant where you get this huge volume, it's not sustained, it increases and drops very quickly. And in doing so, what this does is it slows the move down, so you get that volume drop. You see this very, very quickly. You get around about 6 minutes after that candle with slightly higher volume. Again, as the market is kind of shaken up a little bit, it produces a bit more trade and very quickly falls back down. This is why you end up with such a low volume candle afterwards. As such, rejection moves look different. Very, very high volume on a very short-term basis, lower volume overall on a longer term basis. And what you end up with is this bounce, and then the market starts to gradually drift back up. It's not sustained. That's the key bit here. Volume drops less than half of the spike volume instantly. Straight away, you can see that this isn't being sustained. This is just a fallback of volume. And as such, that's a good indication that this move is over. So that's one way to see the end of move. It's what you call an exhaustion move. Volume spike, moves over very, very quickly. If you did see volume staying up in this period and volume being able to reach similar levels as we start to bounce, then you can have greater conviction that this is going to keep on going. And it's only after the fact that you can see that the volume is much lower on the hourly perspective. And what that's illustrating to you is that what's happened here has been limited. It's been instant and nothing more. So what we're going to go and have a little look at here then is, again, another example using a 60-minute and a 1-minute candle. On the 60-minute chart, volume on the whole is reasonably high, but note where the volume is higher. It is higher on the green reversal candles, not the red candles on the way down. And again, you see a similar type story. Big spike in volume on the way down and almost instant again. Sudden, huge increases in volume, if they're not matched by news, are a good indication that you are seeing exhaustion, that you are seeing a rush or a panic of action. Good indication it's time to be giving up on the trade, or it's a time to start thinking this is perhaps the end of movement, at least short term. What we then get is a lower volume bounce. But if you think of the cumulative volume of these candles here, that is going to be equal to what's happened just here. So on this move down, you do get increased volume on this 60-minute candle, but within the bounce, volume gets dropped down. So this shows that relatively the move isn't being sustained. And you can see that in the action that comes afterwards. So now you have this stabilization period. Volume generally falls away. So at this point, we are now in a period of indecision. We could go either way here. And just because you've had the instantaneous end of movement, the exhaustion stopped, and then the market starts to bounce back, doesn't mean that the move down is over. So what you're waiting for now is the volume to start to increase again. Once volume starts to increase again, this is an indication that the next leg of the move could be on, be that a reversal leg or a continuation leg. And the same rules apply once again. Is this a case of a sustained increase in volume that is going to create a breakout move? Or is this once more an instantaneous increase in volume that is going to indicate another short-term end to movement? What we end up with is this steady increase in volume. Now, it's not huge and not really, really obvious, but you notice quite clearly if you kind of draw an average increasing in volume here, increase moving into the top of this range and increase out. Different to what you get here, because what you get here is volume does increase as you approach the lower end of the range and very quickly falls off in this zone here. An early indication potentially that the reversal is coming as well, because given the chance to go down, it's not taken it. We end up here, increasing volume once more, and you could end up with a similar scenario to what you end up with down at the lows, but increasing volume up to here, you want to see it increase again as you reach the highs. It does, there's your chance for the break. So that's in using that combination of a rejection, followed then also by the volume increase that allows the breakout. And you note as well, on an hourly, volumes do increase on the green candles on the move back up, that's this move here, more so than it does on the red candles after you've had that initial drop. Right, exhaustion moves. This is something that if you're not seeing major increases in volume or decreases in volume, so a kind of relatively flat volume on a move, something that you often get on these kind of very consistent moves. If you're seeing that, a good way to look at a move like this, and if you're in this move, the absence of a change in volume should be a good indication to stay in a trade. So it's not necessarily just about volume being sustained or a sustained increase in volume. It's also that in the absence of anything changing, there's also no reason to be out of the trade. So you take this move here, what you're getting is this steady grinding move lower. We don't see a great deal of change in volume. If you just take this volume here, this could quite easily be the kind of volume that you see in a sideways range. In which case, if you saw this type of volume in a sideways range, you would assume that volume is likely to stay the same, or that range trade is likely to continue. Here, lack of change in volume, but direction, and that's fine. If you're short, you need to wait now for an exhaustion. That's going to be the indication of the end of movement, because without that exhaustion, what is it to say that the next few ticks down is going to be any different to this move, and that this can't continue onwards off the page? So if you're looking for either a reversal or you're short and looking to get out of a move, volume helps. What we end up with here then is this steady, steady, steady move down, volume spike down, huge pickup in volume, volume drops very quickly back down to this relative low volume, and we now start to see the reversal coming in. So this is what you're after. This helps you time your move. It helps you step away from the temptation of thinking, that's gone a long way, maybe there's a chance to buy it. And getting sucked into this temptation to think there's an opportunity. It's very easy to do, particularly when you see a market falling and you've not been involved in it and you want to get involved. One of the easiest things to do in that situation is then to think, right, well, I can't get short, it can't keep going down, I better buy it. And what ends up happening is you end up buying it and it dribbles lower and lower and lower and lower. If you can just step back and say, right, I need to see that volume spike, I need to see that exhaustion. Once you see that, that's where you can say the move is finished. That's the point where you can say, okay, now I can have a go at buying this. Right then, so we've looked so far at rejections of moves, which have generally come from a volume spike. What we're gonna have a look at here then is what I call a volume fade reversal. So where volume fades away. And with volume fading away, it doesn't mean that the reversal is on. It means the reversal has potential, and this is what is so crucial with any kind of indicator. It's saying to you, there's options here, there's a chance, but you still need to find an access point. And when we talk about delta, that's going to become even more noticeable. So what we end up with, typical type scenario, volume increasing, you start to see a drop coming. So you get this drive down. This is an example using the Bund, just so you all know what market we are looking at. So you see an example in the Bund, market starts to fall down, volume starts to increase. Brilliant, just what you want to see. So you can be quite happy to stay in this. What we then get is a spike in volume to the upside. This is a first clue that this move could be coming to an end, but that's not going to be enough to sort of say, right, you need to be out of this trade, but it's information. What we then see is a second leg down on noticeably lower volume, this little blue box that you can see in the middle. Noticeably lower volume on the move down. This is a move that you can look at with suspicion. This is a move you can look at and think, I'm not sure how much I want to be involved in this. And if you are short, that's okay. There's nothing to say you need to be out, like with that previous example. You don't have to get out of the move, but you can have what I call a lower tolerance to exit. We'll talk about this more with entry and exit. Lower tolerance to exit, you'd be happy to give this up. So market continues down, you're already thinking there may well be a chance of a reversal here because volumes are starting to drop down. Once you get this move down, even this breakdown, you still don't see an increase in volume and very quickly you move back up. That would be a point where I'd be thinking this move looks over. You've had an initial low, you get a bounce, continuation move, no further movement on this. That break, incidentally, this continuation move takes you down through these previous lows and you don't get any further movement on it. That's a good indication this could be over. So what you're now seeing is volume fading away. This is now saying to you there could be a chance of a reversal. Look out for a volume increase. We've achieved breaking a level, so you've reached a point where a reversal is reasonable. Volumes have failed to continue on the move down. Now you're looking for an access point. We start to establish a low down here. That's not necessarily going to be enough to get you in the trade. If you want to get in early and you want to look at it and say, well, I'm going to use the assumption that if volume's falling, we can't sustain the move down as a basis for a reversal, then you can use that. But you've got to be aware that there's nothing confirmed at this point in time. Once you start to see volume increasing in here, now all of a sudden you can start to have a little bit more conviction. You can potentially buy this in the range as we start to move towards the top of range. You can alternatively buy it as we break the top of range. And that's then the point where you start to see volume continue to increase. That gives you this very, very fast move up. Volume surges and then starts to drop off. And once again, you see a similar type thing, much, much quicker. Volume surges, volume starts to fall at the top, and then you start to get the reversal. Good indication of the kind of end of movement. Volume drops off, not quite as fast as that instantaneous exhaustion, but volume drops off towards the top. That's a good indication of potentially the end of move, particularly as this occurs on the break of a high. If you're looking for a break, you should be seeing volume increase if this is going to sustain itself, and it doesn't. Volume falls. So volume's going to fall as you reach a point where it should increase if we are to sustain a move higher. That's a good indication of an end of movement as well. So that's your volume fade reversal. It's not about being able to immediately use that spike of volume to get short, to get into a counter trade, long in this instance, but it's about seeing that fading off of volume that says to you the reversal potentially could be on, and you've now got to find the entry point for that reversal. Right, we're going to look more and more at this when we get into volume profile, but if I bring in the first iterations of volume at price, first iteration of a kind of volume profiling. We're going to touch on this more when we do order flow, a little bit more on entries and exits, and of course volume profile. Now, what I've talked about so far is falling volume being an end of movement. Falling volume doesn't have to be, because for a counter move to happen, for a market to bounce, as we've already talked about, for a market to bounce, you now need, after a drop, let's say, volume falls and the market's then going to start to bounce, you now need to see new buying, which is going to drive the move back up. If that doesn't happen, what you can end up with is short-term periods of consolidation. And so these short-term periods of consolidation, whilst volume may well fall during them, and if you look down here, each of these little green candles, so you get 3 green candles down here where this bottom blue arrow points, volume's much, much lower. But that lower volume increases volume at price because we're seeing less directional movement. So that lack of directional movement increases volume at price. So rather than looking at it in terms of how much is traded on each leg of the move, you can look at the areas of high and low volume, break the move up. All of a sudden, you now start to see where the market is happy trading, where it's consolidating. And as such, you can then use the areas of low volume as your stops. Place your stop above that, and you can protect yourself on the move. Because as long as you're seeing volume increasing, volume at price increasing, that is, what this is showing is that there's consolidation. There's two-way trade here. And then you're waiting for the next leg of the move to come. And as that comes, you then get the surge in volume, as you see with these 3 spikes, these 3 red spikes, which are each of these large red candles on the move down. Volume increases again as movement happens. As we trade through more prices, faster movement, less volume at price. The market drives through those prices, less volume at price, faster movement. That gives you the move down. After that, we then start to see flatter volume. You don't get these spikes in volume, and the more and more time down here, volume at price increases. This shows that the market is happy trading in this zone. You see much more two-directional trade. We'll talk about this more in terms of auction theory and price discovery in profile week next week. But that's what's happening then on the volume at price. Useful way, you see this on the side of your ladder, to view a move and to view the points where essentially, whilst you have got very high volume, very little of that volume will have been traded at that point, at the lowest volume points. Because what's happened there is the price has driven through them. Anybody sitting on the bid has been eaten up instantly. Markets drop down, bang, 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 through what's there, little bit of volume trades, and then you'll see more volume trade once you start seeing that there are some buyers down there that it takes more effort to get through. And so this then creates the market taking a breather, more volume gets through as it uses the effort to get through that next leg or that next area, and then you get the acceleration once more. So that's how you're looking at volume profile. I give you a slightly different perspective on the volume histogram, and generally the higher volumes on a histogram perspective, at least short term, are usually going to tally up with areas of low volume on a volume at price chart, because simply these are areas where a lot of volume is traded because you traded through multiple prices very quickly. So you traded across distance, but you've not spent any time at any one of those prices. So a lot's gone through, but it's been very, very well dispersed. Whereas here, less has gone through, but it's been very, very concentrated. This is your kind of uncertainty, indecision zone where you're getting this sort of consolidation battle between buyers and sellers before then the next leg that comes. Of course, you can get reversal. If you start to see that, that's clearly the end of movement. Last thing to look at with volume, and this is something that we'll look at when we look at market manipulation, but anomalous spikes, particularly when they don't match up to any other market. So you're looking at your market and you see these sudden spikes in volume. Dispersed, they don't create a continuation of volume, they don't create any change in the actual candlestick chart. But these are good indications that something's going on. And you might want to spend a bit of time paying attention to this. So, like I said, we'll look at this in order flow week. I'll look at these 2 examples. These are examples in the FTSE, but it's a trade that I've seen previously in the DAX, trade that I've seen in oil as well. These are indicating that there's an order flow event happening because nothing's really changing in price direction. This spike in volume creates this candle, which is around about 10 ticks wide. It's not huge, but the volume suggests that a lot has gone on here. 1,200 contracts in a minute on the FTSE is high. FTSE will trade a similar type kind of volume to the DAX. So a huge amount of volume goes through very, very quickly. This should be initiating your idea, your thoughts towards maybe there's an opportunity. Maybe I need to start watching this, because you can then work out what it is that's causing these spikes in volume and how you can then trade it. So it's a way of drawing attention. It's a way of sort of tracking a period of time, thinking, right, I'm going to watch this, I'm going to work out what's going on and see if there's an opportunity. I'll show you the order flow event on this when we do order flow week, when we look at manipulation, at flipping, because this is a great example of it. This type of thing happens on its own. No other market displays this spike of volume. Very quickly, you should be thinking, market doing something completely independent of everything else, very short period of time that does not change direction at all, is a great indication that there is something going on that is a little bit amiss, and an opportunity then for learning what that order flow event is.